Do you sell your best stocks too early? Or do you get shaken out by the pullbacks along the way? Or maybe you get a small early gain and then you cash it in because you don't want to risk giving back a small profit. If you're having trouble in any of these areas, then this video is going to help. My name's Jason McIntosh from Motion Trader, and this video is all about staying on big trends. I'm going to tell you how I use a trailing stop strategy. I'm also going to tell you how I decide how wide to make that stop and what makes it work. And if you stick around, I'm going to tell you about a free piece of software that you can use to calculate your own professional grade trailing stops. So having said all that, let's get into a chart. So the chart that I have up here is for a big Canadian uranium producer called Cameco. I'll tell you why I'm using this as an example in a moment, but really this could be any stock chart. What we're talking about today applies to so many big trends. There are so many examples that we could use to go through for this video. But the first thing we need to do when we're looking at exit strategies, when we're looking at trailing stops, we need an entry point. We've got to say, look, where have we gotten into a trade? And the way I approach entries, I'm using moving averages and breakouts. So on this chart, I've got a 50-day and a 100-day moving average. A theoretical entry point for me is when these moving averages cross, the 50-day goes above the 100-day, and we get a breakout to a new high. You can see this yellow circle. That's an entry point from my rules-based entry approach. Talk about entries another day, but for now, that is our entry point. And you look at that entry point and you see where the stock has gone since, and well, it's had a big run. It's been up 300%. So at the high, at the recent high, it was up 300%. It's pulled back a bit in recent times, up about 240% at the time of filming. So when you look at this, the question is, how do you get this? How do you get a stock that moves from the bottom left-hand corner of this chart up to the top right-hand? And how do you get it? How do you stay on it? How do you profit from it? And I can tell you, there are two key things. There are two key things in getting this type of move. Now, first of all, and this is an important starting point. First of all, you've got to resist the urge to take small profits. So you think about the entry point for this trade, and we move it, just compress this chart back to an earlier time, and you can see the entry point had someone bought at this point. What often happens is people get an initial gain and they go, that's great, I'm going to take that, I'm going to cash in for a 10 or a 15 or a 20% gain, whatever it is, because I don't want to risk a situation where the share price pulls back. And so they get out. They're out of the game. Now, here's the thing. If you're always cashing out for a 10 or a 20% profit, how are you going to get 100% gain? People say, well, look, I can get back in, but more often than not, they don't get back in, and they end up looking on from the sidelines as the share price moves on without them. So that's the first thing. That's the first thing I can tell you. If you want to go for triple-digit gains, and of course it depends what your goal is. Not everyone is going for 100% gains. Some people are short-term traders and swing traders. That's all fine. It's a different thing. But if you want to trade medium-term trends that could last for maybe 1 or 2 years, if that's your game, then you need to resist the urge of taking small profits. Now, here's the second point, and this is just as important, and this is what I want to really focus on for the rest of this video. It's such an important thing. If you want to try and get these big gains, you've got to be able to see off the pullbacks. Look at all these pullbacks along the way. This stock doesn't move higher in a straight line. It's got all these pullbacks. That's part of staying on big trends. But so few people seem to be able to see off these pullbacks, which periodically occur within a large trend. And you can call up a trend of any stock that's gone 100%, 200% or more. Call it up and have a look at it and just count. Just count how many pullbacks have there been of between, say, 15 and 35% on the way up. And more often than not, you're going to count several. And this is how the stock market plays out. It's people look at this chart this gain has taken place over a bit over 3 years. People will look at 3 years and just see a big sweeping upward move, but that's not how it plays out in real time. You get those pullbacks, and this is what the strategy I'm going to be telling you about is all about, trying to see off. And um, if you can't see them off, well, you can't be in the game for these big potential gains. And I think the biggest issue for people when we do get these pullbacks, we get a bit of a rally, and then we start getting a pullback. And the difficulty for most people is uncertainty. And especially if you don't have a good process, if you're just relying on a bit gut feel or what you're reading in the newspapers or what someone's saying about it, and you don't really have your own process, the uncertainty of sitting through this decline can be unbearable. And you wonder, like, look, how much further is this going to go? Is this going to continue all the way back down to where I got in, and so on, and worse? And this is why people will then move to sell when they start getting these 5, 10, 15% pullbacks, because they're worried just due to the uncertainty of what could happen. And we'll only know the peak in hindsight. But for the chance of staying on board what could be a really big trend, I think the only way we can do that, and at the same time managing risk, I think the only way we can do that is through what I would call a wide trailing stop. And that's what, for me, I think that's the best way to be able to balance between managing risk and having an exit point and staying on these big trends. But for so many people, just wanting to shut down risk is their key objective, and they sell on 5 and 15% pullbacks. Now, if you're not sure what a trailing stop is an exit point that travels beneath a trade's high. It travels a certain distance, which you set, which we'll talk about in a moment. It travels a prescribed distance below the trade's high, and it follows up until the stock eventually comes back and ultimately touches where the trailing stop is, and that becomes the exit point. So I'll actually put a trailing stop on this in a moment. And this is a classic example. It's a classic example, and this is why I'm using Cameco, because it's not a nice, smooth upward trend. Everyone wants a nice, smooth trend. You want a stock that goes from $1 to $3 with virtually no pullbacks. It's linear, it's straight, it's simple. It doesn't work like that, though. Stocks zigzag. They zigzag their way higher. Look at this. Look at this move in Cameco. It's not nice and straight. It's jagged. It's zigging and it's zagging, and the zags drive people crazy. It makes it really hard for them to stay on these trends. That's volatility. That's the stock market. It's unavoidable. And here's the thing. We need to follow a good process, and then we need to learn to live with volatility. And a good process can help us around that living with volatility aspect. And the thing is, we can't shut down volatility. Whilst that may be the dream, shutting down volatility also shuts down your upside. And people wanting to limit their trailing stops or limit their risk to 5 to 10% of a move, it's that desire to shut down volatility. But as I say, you can't get these big 300% gains if you're only giving your stock 5 or 10% to move around. You're just knocked out, constantly knocked out. You can't stay in. Sure, you might get a takeover situation where a stock shoots higher overnight, but I think as a general proposition, you're not going to stay on big trends with tight trailing stops. It just doesn't work. Call up all your own examples, see for yourself. Doesn't work. And markets, they don't move in those linear, they don't move in those smooth lines. And this is the other thing to remember. A stock can have plenty of scary sell-offs. Like, look at this. This is a 30% pullback in this stock. Can have plenty of these scary 30% sell-offs, then within a few months, be back at a new high. That's how the stock market often plays out. This isn't unique in any case. It's a classic example. And I think what we're trying to really do with that wide trailing stop is trying to help you to see off these moderate pullbacks. these are, in the scheme of things, whilst you think you might say 20%, 30%, 35% is a bit of a pullback, in the scheme of a 300% advance, it is moderate. It's a moderate pullback. That's what we need to be able to see off if we're going to stay on these large trends. Now, what I want to do now, I want to actually put a trailing stop on this chart, show you what one looks like, show you how it's calculated, show you how I set it. By the way, if you're getting some value from this, please hit that like button and just leave a short comment. What do you think of trailing stops? What do you think of the way I set them? Really interesting to hear what you think. Now, let me do a trailing stop on this. So the trailing stop I'm going to use, this is the trading, it's called TradingView. Great software. Just Google TradingView, you'll find it. Give you charts from stocks all around the world, all sorts of other things, whole lot of indicators. And it's either free or inexpensive, depending on what your setup is. Really good stuff, and you can do this yourself. So once you're set up, and you can follow my lead as I'm going through now as your own guide as to how to do this. You call up your stock, you go into the indicators. I've got this preset. It's an ATR stop loss, an ATR trailing stop loss. I'm going to apply that. Now, this is a little bit different to the one I use in my Motion Trader service. I've got a few modifications to it, which I think enhances its performance. But for the purpose of this is a really, really good way to have a look at it. So I can just click on the chart now, and it applies a trailing stop. Now, you've got to look pretty closely to see this. Can you see this line just tracking up beneath the share price? And then that's a trailing stop. And within a few weeks of our entry, the share price cannons back, and here's a trailing stop, trades over. Doesn't last very long. So you might be thinking, well, that didn't work out too well. But it all depends on the width. What is the width of your trailing stop? This is key. This is where so many people go wrong. This is where the big mistake is made. Now, I'm going to go up. I'm going to adjust the width. So I'm going to go up here. I'm going to click the cog, which is settings. This little box comes up. You can see where it says multiplier. It's set on a multiplier of 3. This one is using 3 times the average daily trading range over the last 14 days. I'm going to change it from 3. Why is the default 3? Well, I guess it's because everyone loves using tight trailing stops that don't really work. But that's what people want to do. They want these tight trailing stops. Look at it. Doesn't get anywhere. If you're using a short-term swing strategy, maybe there's a place for it. But if you've got any desire to ride a stock to 100% gain, 3 is just not going to cut it. I'm going to move to 10. This is what I use. I use 10, a multiplier of 10. I can hear people already thinking, what on earth are you doing with 10? That is a huge stop. It's wide. It's wide by design, and there's purpose for it. I'm going to show you. Let's click on this. Now, this line beneath the share price, this is a trailing stop. You can see how it tracks the share price all the way up. And this is how you stay on. This is how you stay on from this theoretical entry point all the way up to 300%, back to 240% now. It's still in the game. It's if you were using a wide trailing stop, you could have gotten this stock and you could have ridden it up for somewhere over 3 years. I call this an active investing approach. It's not getting in and getting out. It's about trying to find stocks with that momentum that can last for many months or even a year or two. That's where some really big gains can be made. And trailing stops, not magic, it's calculated. I really like that it's calculated because things that are calculated are repeatable. They're not relying on gut feel. They're not relying on someone's opinion. They're not discretionary. They're calculated. They're repeatable. You can apply them over and over again. You won't get the same outcome every time. Not every stock is going to do this. And that's okay. They don't all have to do that. But if you apply a winning process and you apply consistently, you should get good outcomes over time. And sure, there are going to be times where a small profit becomes a small loss, or you get a moderate profit and it comes back to become a modest profit, or maybe a stock stalls altogether and just goes straight to your exit point. That's going to happen. That's all part of the process. But the trailing stop gives you the potential of getting on these big gains and staying on them for a long time. That's what we're after as a medium term, at least for me, as a medium term trend following investor. This is what I want. I want these big multi 100% gains, and I do get them. Um, we don't get them all the time. I don't get them with every stock. I've currently got about 50 stocks in my portfolio. About 10% of them, it's 5 or 6, are up over 100%. You don't need all of them, but if you can get around 10 or so percent of your stocks really punching out big gains, that's where you potentially get that outperforming portfolio, provided you're also making sure you're minimizing your losses on the downside. We want to run our profits. We don't want to run our losses. We want to cut them relatively early. Risk management is so important, but that's for another day. This is about managing the trailing stop. And but what fascinates me, so we look at this and go, look, why would you not do this if it's just such a clear-cut way of being able to manage a rising position whilst managing risk? Why would you not do this? And it fascinates me because, and I've been told this a couple of times this week, people will come in and trial my Motion Trader service, and they'll send me an email and go, hey, Jason, I really like your approach. I like this buying with strength. I like this letting profits run, and I like cutting losses. I like spreading risk. I like looking at all these possibilities. That's all great, but your trailing stops are too wide. They don't work. They can't work because they're just too wide, and I can't use them. And this happens so often. People come in and they think, look, I could lose all my money in one trade. That's completely incorrect. But this is what a lot of people just don't understand. They look at a wide trailing stop and they say, look, 25, 30% pullback, maybe that's too wide. But there's a reason, and this is why. This example shows you exactly why the wide trailing stop is such a critical part of riding large trends. And if you can do it, I think you're in the minority, because most people can't. They either don't see it or they can't do it. Emotionally, they get all knotted up. They can't follow the process, even though I can show them through backtesting, through real life examples, through examples like Cameco. I can show them many, and they can't do it. So it's an interesting thing. Big profits are entirely achievable. But people's desire to shut down risk, shut down volatility, it also shuts down their potential for staying on these big trends. But as I say, these big trends are entirely achievable if you know how to do it and if you have that wide trailing stop. So look, hopefully that's been interesting. Hopefully you get some really good ideas about how you might be able to manage those winning positions better and let those profits run, and be able to let them run longer by giving them the right room to move about. Hopefully you can apply it to your own portfolio. So look, that's been fun. I've enjoyed talking to you about all of that. And look, thank you for joining me. I look forward to talking to you again later on. Till then, bye for now.